Earlier this week, I was joined by Dr Scott Osborne for our quarterly market update. We discussed how summer 2025 is shaping up to be a hot time for global macroeconomic events, and how in the midst of so much risk and uncertainty, the team managed the VT Astute funds. Before we get into it, I'd like to share some exciting news. The VT Astute Conservative Fund won Citywire Wealth Managers Award for Best Fund Group in the Conservative Mixed Assets category. This recognition comes at a particularly meaningful time, as the fund turned 5 years old in July, meeting its minimum recommended investment time horizon, with that being 7 and 10 years for the balance and growth. This award is testament to the consistent risk-adjusted approach our investment team brings to managing clients' wealth, even in uncertain markets. Thank you to our clients for your continued trust. Now, let's get into it. Hello and welcome to the latest quarterly market update for Q3 2025. I'm Hannah Kennedy and I'm joined by Dr Scott Osborne. So Scott, the first thing that we'll look into, summer is typically a time, you often say this, that markets are a bit quieter. You know, people are out of the office, but not for global events this year, clearly. So just to think of some things that we could go through, the 90-day tariff pause has ended, linking to the trade wars that we may be seeing, the US bombed Iran, actual wars. UK rates have come down, Trump is meeting with Putin. Can you help us to decipher what out of this is the most important?
Easy job there then, just everything that's going on. If you told me a year ago that the US was going to drop bunker buster bombs on Iran, then I think I probably would have been a lot more worried than how it actually turned out in the end. And that really just shows you like the scale and breadth of all the news that's been occurring, so far this year, and that sort of memory of that, which I think is about 8 weeks ago where we are today, has already faded. So I'll try and get around everything that I think is sort of relevant and important, but keep it high level. So obviously from the beginning of the year, the big thing is the trade war. You mentioned the 90-day pause that sort of ended up relieving some of the pressure around that has now elapsed. They did eventually get some deals done, particularly with Europe and Japan, which are the big ones. And essentially in terms of the whole trade war, while there is stuff still happening, particularly around India and a few other places, we're kind of settling on an average tariff rate in the US somewhere, say between 13 and 17%, something like that, which is a lot higher than it was, just a year ago. It was something like 3%. And we know this actually now because the US is starting to make money on those tariffs at the border. The Trump administration can crow about how much money they're making, but essentially it's just a tax that's being collected, and they are collecting quite a lot of taxes in that regard. So that's one thing. There's still a lot to rumble on, and there's still lots of uncertainty about how those tariffs, work their way through, whether there's what they call transshipping or diversion of trade flow, whether China tries to get its goods into the US via another route. All that stuff is still sort of happening, and we'll find out as it happens. But in terms of tariffs themselves, it feels like we're reasonably settled there. On some of the other areas like inflation is still out there. This feels like kind of yesterday's thing now, pre-Trump. Central banks are still sufficiently worried about inflation, particularly obviously because of tariffs in the US. That's led to a lot of pressure on Jay Powell, the chairman of the US Federal Reserve, to cut rates, and he's kind of held, and there's a lot of pressure there. But essentially across the board, particularly in the UK as well, less so in Europe, there is still enough inflation out there that it's worrying central bankers. But despite that, on the other side of that coin, interest rates, there has been interest rate cuts. Just last week for the Bank of England in our case, almost certainly now in September for the US Federal Reserve, but we'll see. And then then like you said, there's kind of the actual war, which I guess is kind of one of the areas where there's still a reasonable degree of uncertainty. But you mentioned there that Trump's sitting down with Putin in Alaska, I think, this week. This is where some of those themes are all kind of intermingling, because obviously one of the ways that Trump is trying to apply pressure on Russia is by adding extra tariffs on India, who is taking most of Russia's oil. And you can see all this interconnected global world. Trump is very much using every lever the US has to achieve his aims and objectives, and we're seeing that now through that Ukraine sphere. So it feels actually like a lot of the balls which are in the air have kind of started to come down, but there is, just because it's been such a busy year with just so much happening, doesn't mean that, because we've got kind of resolution in some of these areas, that the risk has gone away. It's just that actually we can sort of plan a little bit more around that. It is still a huge amount of things to consider and a huge amount of moving parts out there in the global economy to keep track of.
Brilliant, thanks, Scott. With so much happening, I mean, how do you factor all of this into the portfolios?
That's the day-to-day. That's what keeps me awake, right? But no, I think one of the more, and I kind of alluded to it a little bit already, one of the more useful frameworks perhaps for this type of stuff is risk and uncertainty, and this is kind of economist jargon. I think it was Keynes who originally kind of sketched this framework out. But the risks out there which we see, these are like things that we kind of, the known unknowns, and we can basically assess that risk, attach a probability. Do we think it's going to happen? Do we not? What was the impact of that? And we can adjust the portfolio accordingly on that. And Iran is a good example of that, right? I think in advance, if you told me that was going to happen, I would have said that actually the risk associated that was higher than it turned out to be. But I could have attached a number to that and told you the areas of the market that were affected and so on, and so planned the portfolios around it. Indeed, we did in the early part of the year. Uncertainty, however, is more to do with what Trump, just Trump tomorrow. What does Trump wake up and do? And it's a complete unknown. And uncertainty is much harder to deal with because you are literally flying blind. I think that's quite often the metaphor for risk versus uncertainty is, okay, you get in your car in the morning and you're going to make a journey, the road is icy and maybe weather conditions aren't ideal, but you have the skills and ability to make a judgment on how risky that journey is going to be. That's risk. If you were trying to make that journey blindfolded, that's uncertainty. You have absolutely no idea what you are going to do or how you're going to do it. And that's how we're kind of thinking about the portfolios. If there's risks like the effects of tariffs and trans-shipping from China and where those products might go and the effect on inflation and stuff, we can make a guess and we can attach probability and we'll change positioning on it. If there's uncertainty, we just by instinct probably have to be a little bit more cautious around that because these unknown unknowns have a way of kind of manifesting in unexpected ways that you just have to be intrinsically cautious of. And we think there is a lot of uncertainty out there at the moment, and that's what has made us more cautious, basically. Risks are always, as much as they are, a chance to lose money, a chance to make money, risks and opportunities. If you get things right there, you can deliver good performance, or you can, good risk-adjusted returns, let's say. Uncertainty is just a bad thing. It's unequivocally bad. It's just hard to do anything. And we actually see a reasonable degree of that in the economy as well. It's businesses making decisions around investment and so on and so forth. They're also living in this uncertain world, and knowing that makes us slightly less positive about the situation because they're in the kind of same shoes as everybody else. So I think when you put it in those two kind of columns, you add up one, you add up the other. Clearly, in some areas, we can just mitigate risk and reposition. But when we see this degree of uncertainty increasing, the sensible thing is just to rein in risk a little bit. And it doesn't mean we think the world is going to end or there's going to be a recession or anything. We're just cautious around the fact that there's things going to happen and we have no handle or grasp on what they might be. So let's just be a little bit more careful. It's as simple as that, really.
Okay, brilliant. So we've gone through all of those areas. Are there any areas that are still out there that you can actually weigh up the risks and have a little more certainty?
Yeah, well, yes. I mean, it's a fair question. I suppose going back to like I said, kind of last year's hot topic, inflation and interest rates, we've got more certainty around that stuff than we have done in the past, or it feels like it. We had as I mentioned, the cut from the Bank of England last week, and although there was lots of noise around, the Bank of England had 2 votes for the first time in its history, or kind of thing. Basically, all that happened is that the majority of the committee wanted to cut rates. Obviously, it's a tight judgment, so you have this vote, but it was marginally in favour. And then the longer term effects of that is actually we're probably still going to have 2 more cuts, so we'll get down to 3.5%. That's probably something like where rates get to in the UK, and maybe on balance it takes a little bit longer than markets were expecting before last week's meeting. We can be reasonably confident in those guesses, and they are still just guesses, and other things could happen, but that's a reasonable, there's a risk, but there's a reasonable degree of certainty around those outcomes. The same is true in the US, even though President Trump has been leaning on Jay Powell, who's the chairman of the Federal Reserve, to cut rates, and he keeps saying fairly ridiculous things about how much they should cut rates. He's threatened to sack him, and that itself is kind of probably in the uncertainty bucket rather than the risk bucket. In all likelihood, the path for US rates is down, and they will probably cut rates for the next time in September, and then maybe another couple of rate cuts after that, because inflation is generally under control. And again, there's there's risks to that outlook. The economy could develop this way or that way, but there's a reasonable path there. So these are the kind of areas where we feel reasonably confident. And obviously 2 years ago when inflation was we were still in this uncertain world of where inflation was going to materialize and so on and so forth, it was slightly different. So it's not all negative. There are areas where we're reasonably more confident that things are getting back to normal, quote unquote normal, and that's good. It's just that there is this big kind of, like I say, if Trump really did want to sack Jay Powell or interfere with the independence of the Fed in the US or something, that would fall in this uncertainty bucket, and it's unsure then how markets would react to that or anything. We don't think that's going to happen, but like I say, that's the problem with uncertainty in general. So really, it's probably just best to be more cautious around that than otherwise.
Fantastic, thank you. So what does all of this mean for the positioning of the portfolios?
Well, yes, obviously, I've been saying there, all this uncertainty type stuff, we are more cautious than we were. I think the last time we sat down together, I talked about the whole, react but don't overreact to Trump. And so we did make some changes in that when the initial kind of wave of hysteria had died down. We did dial back risk a little bit. So we took some equity risk off the table. We reduced some of our exposures to what I would say are the more uncertain areas. So some US equities and US mid-cap companies where the outlook was just becoming more uncertain because of Trump's policy decisions and his general rhetoric. And the areas that we were looking to buy, and I think I alluded to in the last video in terms of diversification of returns, is you probably won't be surprised I've talked about so much this video, but is certainty. So what we're looking for is good, reliable cash flows where actually we have a higher degree of certainty that we're going to get some sort of return from this investment, whether that be infrastructure, for example. We bought back into some sort of real assets. So, just physical stuff that's there that generates a cash flow. Those types of investments or income generating stocks, for example, with very stable outlooks. The markets aren't necessarily demanding a very high price for expected future growth like they are on tech companies, for example. Again, a lot of uncertainty in the future path for that. It's just a bit of a boring company that kicks out regular income. These are the types of things that start to look slightly more attractive to us in this environment. And that's how we pivoted the portfolio. So we took some equity risk off the table. Within the balance fund where we were already kind of a little bit more balanced in our risk, we just kind of shuffled our regional exposure a little bit. So we were a little bit less exposed to the US where uncertainty was highest, particularly given valuations. And then in that sort of alternatives bucket, as we call it, that's where we've been buying into these real assets. Like I say, good physical things, whether they be infrastructure, buildings. We bought some student accommodation in the highest risk mandates. That's the type of stuff that should give us a fairly reliable income. But, we're not sacrificing massive upside by owning these things because they're still essentially equities or businesses. So it's not like we're panicking out and going to cash or anything like that. And that's really the balance. That's the trick. I always say this, anyone who's been to one of our seminars has heard me talk, is that 2 times out of 3 markets go up. The hardest thing is staying invested. That's basically my job most of the time. I always remind myself, it doesn't matter how sort of worried or cautious you get about the markets, the odds are in your favor when you're sort of long the market. But we just have to be careful that when we do take a bit of risk off, or that we see these risks materializing out there in the economy, that we're careful in how we reposition around that. We don't want to be in those areas, but we don't want to be out of the market. That's kind of how we see it. So that's basically what's underlied the trades that we did earlier in the year, and probably any that we do through this summer period now as well will be along those same lines. It's just trying to minimise the areas of uncertainty that we see in the portfolios.
Brilliant. Thanks for that, Scott. And thank you for watching. That's all we've got time for today. If you have any questions, then please don't hesitate to get in touch with your financial planner. Otherwise, see you next time.